por debajo del dato de mayo, que estaba en los 2.553 compañías. Ahora sí, ya tenemos con nosotros a Jay Pelosky desde TPW Advisory, el fundador. Jay, thank you so much for being in Negocios Televisión. Good afternoon.
Good afternoon.
Jay, today we had, for example, retail sales in the United States. They grow at a lower pace. Now the monthly growth is just 0.2%. Is this a bad sign for the U.S. economy?
No, I don't think so. I mean, we're of the view that we've had some really good data over the last week or two. You think about the jobs number, you think about CPI, PPI, earnings. So all these are kind of facts on the ground, which are really destroying the fiction that has been going on for the last 6 to 12 months, namely an imminent recession and bear market. And so we've seen kind of some pretty strong cross-asset reaction over the last week. Dollar down, commodities up, non-US equities up sharply. So our view continues to be that we're not going to have a recession, and that we're in an the early cycle of an economic recovery that's being led by Asia, and the US and Europe is going to follow.
Jay, you just mentioned recession, the fact that you believe that we're not going to have a recession in the US. And yesterday, Janet Yellen, the Treasury Secretary, said that the US was not going to enter a recession despite the deceleration of the Chinese economy. I guess you agree with her.
Well, yes, and we really look to the market to tell us, right? And so we wrote a piece called Rotation for our clients at TPW Advisory 2 months ago, literally May 19th, and talked about the rotation from big tech to cyclicals. And we've had that. So the market is telling us, right? If you look at transports, if you look at industrials, if you look at home builders, these are all breaking out to new 52-week highs, and in some cases, all-time highs. And so this fiction, again, that the equity market in the U.S. has been led by a handful of big tech companies is completely wrong, just completely wrong. And so the market is telling us that the early cycle sectors are breaking out, and that's the market telling us. The market is a forward-looking discounting mechanism. It's discounting a better, brighter future.
By the way, Janet Yellen also said that we shouldn't make too much of the June CPI report. Jay, what did she mean with these words? Do you think that she doesn't believe that the disinflationary trend we're seeing right now is a fact?
No, I think she's just trying to kind of keep people from getting too excited. As I said, there was quite a reaction to the number, and it may be a little bit overstated because the big decline was due in part to how aggressive inflation was a year ago. In June of 22, it was up 1.2%. And so we dropped that 1.2% out of the calculation, and that's what brings you down to the 3%. Going forward, the year-over-year comparisons are not as big. So in the second half of last year, inflation was running at about 0.3 or 0.4% month over month. So we're going to have, it's not going to be as easy to see the numbers decline from here. But our view is that rental inflation, which is a big part of the core that the Fed looks at, is going to continue to decline. We already know that. It's just that the data takes some time for the data to get into the official statistics. So we remain pretty confident that inflation is going to be somewhere around 3%. And we think that we're in a new industrial cycle in the United States that we haven't seen really since the 1950s. And we have an AI innovation cycle that's going to support productivity. And so our analog, what we think is most similar to what we're going into, is the second half of 1995. And in that case, the market in the second half of 1995 was up 13%. And so I don't think we're necessarily going to get 13% in the second half of the year, but I would expect the market, equity market, U.S. equity market, to end up higher than where it is today. And the better opportunities exist outside the U.S. in emerging market equity and in commodities, which are the two pieces of the global multi-asset space that really haven't worked yet. And so that's where we see the opportunity right now, emerging markets and physical commodities, namely copper and energy.
Jay, I also wanted to ask you about the earnings that we saw today. We saw, for example, earnings on Morgan Stanley, earnings that were lower than estimates, but today we're seeing it going up 6.7% almost. Why do you think this is?
I don't know. I wish I had some of my stock. I worked at Morgan Stanley for 13 years, so happy to see the firm doing well. But I think that the bigger point is not one company, but the bigger point is the numbers in general, right, in total. And earnings are coming in better than expected. I think 70% or so of the companies that have reported to date are better than expected. Importantly, a number of them are the big banks. And remember, back in March, the bank worries around Silicon Valley Bank. Everyone was afraid it was going to tip us into recession. Of course, absolutely no indication that that's going to happen. And so we see a little bit of interest in the financials as a result of these decent earnings. I'd just say two things. One, the bar is quite low, right? The market consensus is for year-over-year earnings to be down about 8%. So when we have year-over-year nominal growth, and we've talked about this before, nominal growth over the last 12 months has probably been 6 or 7% in the U.S. So to think that we're going to have minus 7 or 8% earnings is a very low bar. So we expect earnings to be better than expected. And more importantly, this quarter is most likely going to be the trough for U.S. earnings. So going forward, Q3, Q4, and into 2024, the earnings are going to continue to be better, and that's going to support the rising equity prices that we talked about a few minutes ago.
TPW Advisory Founder, thank you so much as always, and sorry for the delay. Thank you, Jay.
No problem. Thank you.
Bueno, pues nos decía Jay Pelosky, nos hablaba de